What's going on, everybody, and welcome back to another episode of the Midterm Rental Show. I'm your host, Kramer, and in this episode, I'm going to compare what my return would have been if I took my initial down payment for my very first rental property and put it in the stock market instead. So without further ado, let's go ahead and jump in. Okay, so my very first investment property that I bought by myself without any partners was in October of 2022. And at the time, the S&P 500 was priced at $3,700. And you can even fact check this if you want, but I'm looking at it right now, $3,752. And that was the day that I put down the down payment on this property, which was $39,000. So hypothetically speaking, if I didn't buy the rental property and instead took that $39,000 and put it in the stock market, I would have achieved an annual return of 22%. And that's based on where the stock is right now. So again, at the time of recording this, it's at roughly $6,900. And I could have hypothetically bought it for $3,700 3 years ago. So that's a 22% annual return or an 84% overall return. Now, most people would be really happy about that because the average return in the stock market is 10 to 12%. So getting a 22% return sounds really, really good, at least to most people. But not to me, and let me tell you why. Because instead of buying that stock in October of 2022, I used the $39,000 for a down payment on a midterm rental. And I'm going to show a screenshot of the actual settlement statement to show that it was actually $39,000 for the down payment and that the timeline is actually matching up. Okay, so now that you know I bought the property instead of buying the stock, I want to also show you a screenshot from my Baseline account, which shows how much money I've made from this property in a 3-year span. So from October 20th of 2022 to October 20th, 2025. And as you can see, this property has made an average of $40,000 per year in gross revenue, and about half of that's profit. So as you can see, my total net cash flow from the 3-year span was $57,636. So if you do the math and you compare the numbers between just putting that money in the stock market versus the cash flow from the real estate, you're going to see that my average annual return from this property was 35%, again, compared to the stock market, which was 22%. But if you've been following me, you know that cash flow is just a piece of the puzzle when it comes to real estate. So I want to share the other returns that I've actually gotten from this property, which makes my returns way better. So the second way that I've actually earned more money from this rental property was from depreciation. So I did what's called a cost segregation study, and I was able to save over $10,000 in taxes. Now, I'm not going to go too deep into like what a cost segregation study is and how it works and all the details, but this isn't like I hypothetically like saved $10,000. This is no. I had to pay literally $10,000 less in taxes from buying this property. So given that that is money that I would literally have to pay the government, if you add that $10,000 in savings to the cash flow that I earned from the property, it would now be $67,000 over the 3-year period, which would boost the return from a 35% annualized return to a 39.5% return. And it boosts the overall return in the past 3 years to 171%. But it gets even better because the third additional way that I gained value from this property is from a beautiful thing called appreciation. So when I bought this property, I bought it for $115,000. And if you want to buy a property in the exact same neighborhood today, you cannot do it for any less than $150,000. And that's for a property that's in worse condition than mine. So I conservatively said that the property value is $145,000, even though I know I can probably get $10,000 to $15,000 more. So from the appreciation from the property, I've earned $30,000 in unrealized gains. And even though I can't realize those gains until I either sell the property, which I don't plan on doing, or what I can do, and I haven't done yet, but will do probably at the end of this year, is do what's called a refinance. So again, I'm not going to go too deep into what that is and bog you down on the details. But what I can essentially do is get an appraisal for the new value and then get a new loan at a lower interest rate than I got in 2022. By doing that, I can essentially pull out between $15,000 and $20,000 tax-free from the property, like that'll be deposited into my bank account. And since I'll have a lower interest rate, my monthly payment will be roughly the same. So that could be another $15,000 that I add to this. about a year. Okay, and then the fourth additional way that I've made money with this property is from principal pay down, aka paying down the mortgage. Now, this is actually pretty sad to see, and I look back and I'll again put up a screenshot. I've only paid down roughly $2,000 from the mortgage, mainly because number one, in the beginning of any real estate loan, you're paying a lot of interest. And number two, my interest rate's higher, which doesn't help the cause. Okay, and number five, which is a complete bonus, is that cash flow that I earned from this property, which again was $57,000 over the past 3 years combined. What I did with that money is I reinvested it into other properties. So what I've done is I've had this property buy me another property, which is spitting off $2,000 to $3,000 per month in profit, which if you look at those numbers combined, it becomes literally unfair. So now full circle, back in 2022, I could have taken my $39,000, put it in the stock market, and today that stock would be worth $72,000. But instead, I put that money into a rental property that I ran as a midterm rental. It's generated $57,000 in profit, an additional $10,000 in tax savings. The property's gone up in value by $30,000, and I can pull out that equity if I want to. And I paid down the mortgage balance by $2,000. And as a bonus, I've taken the profits earned from this property and I've reinvested it into other properties, which have generated me significant cash flow. So while yes, the stock market is completely passive, running this midterm rental hasn't taken a lot of time. If I had to put an average to it, I would say 1 to 2 hours per month to actually handle this property. Although it's not completely passive, I'm pretty happy. So let me know what you guys think in the comments below. If you're following the math, tell me if you agree with me. Tell me if you disagree with me. I genuinely want to hear your guys' thoughts. Oh, and by the way, if you are interested in getting into the midterm rental game, I have 3 main ways that I can help you. Option number 1 is you can consume all of my free content that I share on social media between my podcast, YouTube channel, Instagram, and my email list. Option number 2 is I will coach you personally one-on-one to help you find, set up, and run your own midterm rental. Or option number 3, I have a done-for-you service where I'll literally find, set up, and manage the midterm rental for you. So it literally will be passive for you. So if any of those are interesting to you, you can check it out using the links below. And I'll see you guys in the next video. Peace.